Hello everybody, welcome to the first class of microeconomic case studies. Today we will start with chapter 13 of the book of Mankiw. It's basically the beginning of a new part of the book, and this part of the book is about firms' behavior and the organization of industry. So this part, which includes two chapters, is basically talking about how firm behaves given the level of competition in the market and how an industry is organized. That's basically the level of competition in a given industry. To put it in a simple words, consider a simple firm, the example of the cookies factory, which is given also in this book. So if there is a cooking factory or cookie baking factory, how this small firm or big firm will behave given the level of market competition in the economy. Are there a lot of other firms which also produce cookies, or there are few? How to decide how much should be the price, how much should be, for example, the quantity that should be produced. So this part of the book will cover these topics. Okay, so we will start with chapter 13. It's about the cost of production. So as we know, whenever a company is producing its goods and services, the company incur costs. So there are different type of costs that a company has to pay in order to operate. And in this chapter, we will discover what are these different costs and what these costs will actually tell us about how these firms behave, how much they will produce, and how much will be their prices of the product or of their output. So basically, costs are very important in determining the amount of output of a company as well as the price that they will put on their product. Okay, so this lecture, I will do a small introduction to this chapter, and then there are 3-4 main topics, and we will go through the main points and then we will conclude our discussion. Okay, a few points as an introductory to this chapter. So basically how a firm examines its behavior, or how the behavior of firm is examined. It's basically an explanation behind the supply curve. So we know in a market there is a demand side of the market and there is a supply side of the market. Now that we are talking about firms at the microeconomic level, we will be mostly talking about the supply side of the economy. So when we are examining a firm's behavior, we are not talking about the demand, but we are talking about the supply curve of a market. And the firm behaviors determines the decisions behind the supply curve. So what is supply curve? Supply curve is a graph which shows how much of amount of how much or how many product a given company will produce at the given prices. And a few points about the industrial organization. So what is industrial organization? It's how firms' decision about prices and quantities depend on the market condition they face. So, and if we are interested to see how industry is organized, for example, car industry or the industry of, I don't know, hotels, or it could be food or whatsoever. In order to see how this industry is organized, it depends about how individual firms decide about their own prices and amount of quantity that they want to produce. This all depends upon how the industry is organized. I will give a basic example. For example, if there is only one car producer, this company will decide a different type of price and will decide how much of cars this company want to produce as compared to if there are a lot of car production companies. So it really depends about the level of competition in a market in which a company operates, and that company basically decides what should be its price and how much it should produce given the level of competition in a market. We will come back and talk about this more in detail in the coming chapters. The second point about industrial organization is how does the number of firms affect the prices in a market and the efficiency of the market outcome. So again, number of firms also decides what will be the market price of a certain product and how that will affect the market efficiency. The next brief point that I want to talk is about the cost of production. It's basically a firm's costs are a key determinant of its production and pricing decisions. So the cost of production is basically how much cost a company incur in order to produce its output, and that really determines the price that they will finally put on that output and also how many product they will produce. Okay, so that was mainly introduction part. I will briefly talk about the law of supply because we are starting in the middle of the book, so in case you're not familiar with that, the law of supply says firms are willing to produce and sell a great quantity of a good when the price of that good is higher. So according to the law of supply, a firm is willing to sell a larger amount of any product given that the price is rising. So as far as the price of the given product is rising, the producer of that product will try to produce and sell as many products as possible. The second review point is about the economy is made of 1,000 firms that produce goods and services you enjoy on a daily basis. So we will only talk about one specific firm in this example, but there are thousands of companies which produce different type of product that we use on our daily life. So this means like we will be talking about only one or two companies, but basically the economy as a whole is a collection of thousands of such different companies which they produce. They decide how much should be their price and how much they produce the product that they are producing. So that was the mainly basic introduction to the chapter. Now I will move to the first main topic, and it's about what are costs. Before going to explain different types of cost, first let me say what is the main objective of a firm. So the main objective of a firm or a company is to maximize the profit. So every company tries to maximize its profit. So the main objective that you see different type of companies working in the economy, their main objective is to maximize their profit. So that is their main goal. And how they do that, we will explore in this chapter, and we will see how it is possible to maximize this profit. So as you know, I will define total revenue. and we'll come back to what is the profit. So total revenue is the amount a firm receives for the sale of its output. So when a company sells a product, the amount that it receives is its revenue. So that's the total revenue. And how we calculate total revenue, it's basically the price of that product multiplied by the quantity sold. So if this cookie factory, as the example is given in the book, is selling 10 cookies and the price of each cookie is €1, so the total revenue will be €10. I will define what is total cost. Total cost is the market value of the inputs a firm uses in production. So the market value, which means what is the normal price of that input in the market. And as you know, in the process of production, different factors of production are used. It could be labor, it could be, for example, machinery, it could be land or like a factory or whatsoever. So the total cost includes all the costs of these factors of production in order to produce a specific good. In our case, the example is the example of the cookies. So whatever cost that we incur in order to produce our cookies is basically our total cost. Now, what is profit? Profit is total revenue minus total cost. So out of the €10 that we have received as a revenue, we will have to pay the wages of the baker, we have to pay the rent, we have to pay for the ingredients of the cookie. So these are the costs. So whatever remains out of giving these different costs will be our profit. So if we have paid €8 for the wages and ingredients and whatsoever, then the remaining €2 will be our profit. And the firms, this cookies baking factory, its objective is to maximize and to increase these €2. So that's basically the main objective of the firm. How we measure total revenue, as I said, total revenue is the output quantity multiplied by price. So it's really easy to measure total revenue, but when it comes to measuring costs, because there are different types of costs, it's a little bit complicated, and we will explore in the rest of this topic about how to measure costs. So the next title is cost as opportunity cost. As we know, one of the principles of economics is that the cost of something is what you give up to get it. So let me briefly explain what is opportunity cost. Opportunity cost is all the things that must be foregone to acquire that item. So all things that you have to forgone in order to acquire a certain item is called opportunity cost. And I will give another example. For example, you can either study 1 hour or you can work 1 hour. So if you are studying 1 hour, so the opportunity cost of studying is letting go this 1 hour of work that you could do, and then you will earn money. So if you study for 1 hour, that the opportunity cost of studying is the amount of money that you have forgone in order to study. Like you could use this 1 hour either to study or to work. And basically if you choose one, so the other one is your opportunity cost. And that brings us to two different type of costs. One is explicit cost and another is implicit cost. Explicit cost is input costs that require an outlay of money by the firm. So explicit is something that a company has to pay in cash or in check or whatsoever. So it's basically the cash outflow from a company. It's the explicit cost. It could be the wages given to the worker of the company, or it could be the price of buying the ingredients or other inputs for the company. Implicit cost, however, it's the input costs that do not require an outlay of money by the firm. So implicit cost, if you have a company, you are not going to give someone money from your pocket, or you are not going to pay that money to someone else. Rather, these costs are, you have already occurred it, and you are not paying it in forms of money, but they are still costs. For example, if you are working as a manager of your company, you are not receiving any salary. So you are working, in your time that you invest in a company is basically implicit cost. Why? Because you could have worked in another company or somewhere else and then you will receive a monthly salary. So that is the cost that you're incurring, but it's not calculated, for example, in an accounting profit, or you will not say, okay, I have to receive this much of salary from my own company, but it's basically your implicit cost, and that's also a type of cost because it has an opportunity cost. You could have been working in another firm and you could have another normal job, and then you could have earned money from that one. So the total cost is the sum of both explicit cost and also implicit cost. And that's basically how economists and accountants make different calculations about the profit of a company. So an accountant only accounts the explicit cost, so they only see how much money is given away from the company, but they do not count implicit costs, for example, the cost of the manager who is working, or the building that the company is using, which belongs to the owner of the company, or even the capital that is being used to establish this business. It also has an opportunity cost. That money, for example, 50,000 euro, which you have given up to start your company, you could have used that money, for example, for other purposes, or you could have put that money in a bank and then you will receive interest on that. So that is also a type of cost that you're incurring in your business. And as an economist, you will consider these implicit costs also as a type of cost, but usually accountants, they only count how much money has come and how much money has gone, and they do not consider implicit costs. So that's why, as you can also see in figure 1 in the book, accountants are showing that the costs are, that the profit is much more, but if you are an economist, you will consider other implicit costs and you will come up with a lower profit calculation. Okay, so the next topic is the cost of capital as an opportunity cost. Yeah, we have discussed that, and we also talked about the economic profit versus accounting profit. So economic profit is the total revenue minus total cost, including both implicit and explicit cost. But the accounting profit is basically total revenue minus total explicit cost. And the conclusion for this is that a firm making economic profit will stay in a business. So in a long run, a company should be making a profit according to the economic calculation in order to stay in the business. And if you only calculate your explicit cost but not implicit cost, you will probably, your accountant will show you that you're making profit, but still, because you don't consider your implicit cost, you might basically have a loss in your business, and maybe it's better for you to quit that business. Okay, that much was about the cost part of this topic. Now the next main topic is production and costs. Okay, so in this one we will be talking about different definitions and concepts which will help us to understand this chapter and also the coming chapter, and we will be using them several times as we continue our study. So these definitions are important that you are familiar with. Okay, let's talk about first what is the production function. You can see this in figure 2 in the book. Production function is the relationship between the quantity of input used to make a good and the quantity of output of that good. So basically it shows how much input you're using and how much output you're having. So that's a function which shows the relationship between your input and output. For example, in production function in panel A of figure 2, the quantity of output, that's cookies per hour. So how much cookies you produce is on the y-axis, and then the number of workers hired, so how much workers you have. And this graph basically it shows the relationship between your output and input, and that's basically our production function. The next term is marginal product. We will be using this term a lot, so it's better to understand this concept. And the definition is the increase in output that arises from an additional unit of input. So marginal product is how much your product will increase if you add one more input. For example, how much more cookies you will produce if you hire one more employee. That is your marginal. So we don't calculate how much cookies the whole company will produce, but we will say, okay, I hired one person, and this person, as a result of hiring this person, I can now produce 4 or 5 or 6 more cookies. So that's the marginal product. That's basically an increase in output as a result of increasing one unit of input. And you can see this marginal product on the column 3 of table 1. So it's going from 50, then 40, and then 30, 20, and 10. We will talk about why this marginal product is decreasing, and that's our next term, and that's called diminishing marginal product. So the main point here is that as you employ more and more inputs, as you employ more and more employee in your business, your product, your output will not increase the same as the first one. What I mean by that is like the next person you hire will not increase your output the same as the first one. For example, if we return back to the table 1, so when there is one worker, that worker will increase so that one worker will produce 50 cookies in one day or whatsoever. The second, if we hire another second employee, that will produce 40. If we employ the third one, that will produce 30, and so on. What happened is that the marginal product of each input is decreasing. Why? Because our kitchen is small, for example, in this example, or our fixed assets are, so we have assets which are fixed, and then we are not increasing that, but we are only increasing our variable asset, which is employees. For example, probably we only have one oven to cook cookies in it, so that's why even if you have more employees in your firm, but you only have one oven, so that means like you cannot produce more because you only have one oven, and probably you need only 2 workers to operate this oven. If you hire 4 people, they will not increase your output as much as the first 2. So this concept is basically called the diminishing marginal product. I will read the official definition. It's the property whereby the marginal product of an input declines as the quantity of input increases. So in this example, the kitchen is basically crowded. So because the kitchen is too much crowded, it's very difficult for each employee to be as efficient as possible. Or there is a fixed asset, for example, there is one oven, so you cannot cook more cookies at the same time because one is already occupied. So to put it in simple words, as you increase the number of inputs, your output will increase a little bit, but not as much as the first one, or it will not increase as a constant rate, but it will increase at a decreasing rate. Okay, I hope this concept is clear to you. We will move to the next topic. It's a subtopic. It's from the production function to the total cost curve. You can see this one in figure 2. So basically, production function and total cost are related with each other, and these are the 2 sides of the same coin. So what you see is that as the number of employees are increasing, the number of output is also increasing, but at a decreasing rate. So at the top, the 5th or the 6th or the 7th employee is producing much as compared to the 1st or 2nd employee. And it also affects our total cost, because the total cost also depends on how much you produce. So as long as you are hiring more and more people, at the end you will be paying much more to the employees as compared to the beginning, and that basically increase your total cost. So that's why at the end, like if you produce 140, 100 or 60, your total cost is increasing much more rapidly as compared to the beginning when there were fewer employees in your business. So these 2 concepts are interrelated in such a way that because of the diminishing marginal product, your output will finally decrease at a lower rate, and also your total cost will at the end will increase much more higher as compared to the beginning. This concept is a little bit intuitive, so if you read it in the book, you will get it much more easily. If I couldn't explain that well. Okay, so I will move to the next main topic, and that is the various measures of cost. So now we will be talking about the different terms which we use to measure cost, and that basically will allow us to understand more about cost and production function. Okay, so there are several definitions. I will go through each of them and briefly explain all of them. So the first one is fixed cost, costs that do not vary with the quantity of output produced. So it is a cost that is fixed, it doesn't change if you change your level of output. Why? Because it's already incurred cost, and it doesn't matter if you produce or not, these costs are there. For example, you have made a factory, so and you have to pay the rent for that factory. So even if you produce or you don't produce, you have to pay this cost. So this is fixed cost and it doesn't change according to the level of your output. Variable cost is cost that vary with the quantity of output produced. What is variable cost? It is the cost that changes as you increase or decrease your output. For example, it could be the cost of employees. So if you're hiring more employees, your production will increase, but that will also increase your variable cost. But you can hire less employees and then your variable cost will be lower. Average total cost. It's the total cost divided by the quantity of output. So the total cost is basically fixed cost plus the variable cost. And average total cost is your all cost divided by the number of output that you have. So it's basically the average price that you incur in producing of one cookies, for example. Average fixed cost is the fixed cost divided by the quantity of output. So if you divide fixed cost by the quantity of output, that term is called average fixed cost. Marginal cost, it is the increase in the total cost that arises from an extra unit of production. So when we are talking about marginal, it's basically the change in cost. So how much your cost will change if you produce one more unit, if you produce one more cookie. That's called marginal cost. Okay, so that leads us to our next topic, and that's called cost curve and their shapes. And you can see that in figure 4. And here in this graph you will see all the different